Welcome to Insights. I'm Eric. Thanks for stopping by. We're going to do an ES review today. We're going to extend the discussion that we started in an ES report update a few days ago. We're going to talk about the S&P 500. We're going to mention about the energy build that we saw through last Friday that was unusual, but really in itself is not enough to act upon quite yet. And then we're going to tie that in with some of the concepts that we're seeing outside the S&P 500, junk bonds, the VIX, and things like that, just to reinforce what's taking place. The NASDAQ 100 is highlighted here at line 33. Its primary trend is up. The secondary trend is up. It is the daily trend that's down. It's put it into consolidation. It's been down for 16 days. What really raised our attention was the energy build that took place through last Tuesday that was reported on Friday. It was a pretty sizable number, and we're going to talk about that in terms of the equity DI, which is down here. These are things that we talked about in the ES reports. We're going to gloss over them, but then we're going to introduce some of the other markets as well. If we look at the S&P 500, the primary trend is up. This keeps the computer's core position as long. That long position has produced a 6% return in 5 months and 14% for the NASDAQ 100. They roughly flipped at the same time. It is the 827 report, distribution into decline, that raises some concerns with the energy build. As price dropped, the energy build also dropped, which is an indication of a little bit more intense distribution. It is troubling when the equity DI drops below minus 40. We are now at minus 63, and I think a little bit of a kicker added to that is that the decline took place as prices dropped, and a fairly sizable decline, which represents intense distribution. So that itself is troublesome. Normally, the tendency to expect a setup for a further decline would come here in the red box, because the red box is the economic cycle that we've talked about before in the ES report, and this is where we stand with it. This cycle is due to change, but really the economy, which we track through the EAC, and the EAC is located down, it's right around 100 or so, right around there. It's 5 and 2. It's deteriorating. It used to be stronger than that. And you can see the two components of it. The LTCO is the dark red line. It's above the dotted line. The ITCO, which is the blue line, it is also above it, but they are starting to weaken as the stock market is struggling a little bit, but it's still in an up phase. Really, this is going to be the play until this changes. The EAC and the S&P 500 are two highly correlated time series within the matrix. What we call them assets. The EAC is a real-time measure of marginal economic activity. It does not include stock prices within it, and the stock market will move either a little bit ahead of it or behind it, but you're not going to have the two of them diverging from one another for too long. So as long as the EAC stays up, the path of least resistance for the stock market is up, but we already know that because the S&P 500's primary trend is still up. It's just the energy build on the margin that's starting to become concerning. It's not enough for a crash. The what do you call the timing and the correction and crash section, which really lays out all the probabilities. It's still at 50-50, correction, crash, stability, 50-50. That's not a real warning. This number on top will get much higher when the stock market gets vulnerable. We've seen it go as high as 90% right ahead of a downturn. So this is still a relatively balanced market. Where the concerns lie is some of the energy build, but that's not enough to direct what's taking place. If this continues to get worse, if the composite equity DI continues to drop, approaches 100, which is an unbelievably low reading, and very rare, then we will reevaluate this. But for now, what you're seeing is the junk bonds and the VIX, which are also part and closely tied to the economic activity, and the VIX is closely tied to the stock market's performance. They have turned back to triple up and to triple down. Triple up means the economic activity, junk bonds tends to follow the EAC, which is still above the dotted line. So that just reinforces maintaining a bullish phase for the economy, which we've talked about before, but that won't last forever. That's due to end as we get into this red box. And for more on that, you can go watch the ES report. And we'll talk about the specifics of that cycle and when it's going to happen. And also, you're likely to see a big crash in the stock market as long as the VIX is tripled down. I don't care. The VIX is what people say or the bulls say. The VIX is, or the bears say in general, in terms of their timing, the VIX is highly sensitive. And we follow the money. You're going to have a hard time getting a stock market crash while the VIX is still tripled down. It keeps resetting, and it's early cycle, which means that there's nothing inside the VIX. If you look through it, it's a breakout on the daily down. Here's the weekly, and here's the monthly. Nothing is overly extended. So this is a market that's set to keep pushing higher, climbing the wall of worry. I know that's not something that people expected to do. There's a lot of people expecting poor economic conditions to generate a crash in September. And I think we're going to have to work through some of that, but we've got to listen to the message of the market. We have to follow the invisible hand and follow the money. And the conclusion that keeps running through this is patience. Patience that's defined by the primary trend, which is up. The secondary trend is up, and we're still dealing with a minor correction. There are a few problems. We had some warning that took place when the S&P 500, and if you go touch the reversal tab, when the S&P 500 broke through these reversals right here, that got us into an air pocket to the downside that could test these lower levels. This is all standard mechanics that anyone subscribing to the matrix can follow. But as we get stuck in the middle of that air pocket, there's not a lot of evidence other than this unusual distribution that's taking place. We're going to keep an eye on that. We will likely update the ES report again, but the VIX here is the key component. This is just reset back to down, and it's very difficult to have the market go into a weak phase while it still remains triple down. So that's where we stand with the S&P 500. The economy and everything else. We just wanted to tie this review in so that all subscribers can see what's talked about in the ES report, which I view as probably one of the more critical reports other than the dollar report inside the matrix at the moment. It really talks about the things to help clarify what the invisible hand is doing, and it's usually a lot different than what the public is talking about. If you have any comments or questions, let us know. If not, thanks for watching today, and keep an eye on this stuff and keep an eye on the ES report in the future, because I think the updates are going to help us decide where we go through as we approach that transition point in 2024.